Welcome to Chapter 1. This is our first chapter for the Individual Income Tax course, and this chapter provides an overview of why taxes are important, what is a tax, how to calculate a tax, the various tax rate structures, and the different types of taxes. And lastly, this chapter covers how to evaluate a tax system. How these videos will work is I will do a brief overview of what's inside the chapter, and then the videos will be broken into, for example, in this chapter, 3 main videos. Everything that's covered in the chapter videos will be tested on the exam if it is scheduled to be on the exam. This chapter is the main exception. Chapter 1 is not tested on the first exam, and it will not be tested on the final exam. But watching the videos is an important part of this online course because it provides you with all the content that you'll need. So let's go ahead and get started. The first thing that they cover in Chapter 1 is understanding exactly what a tax is and why people care about taxes. And the fact is that everyone should care about taxes because we are all impacted by taxes, whether we are individuals or whether we're a business entity, whether we are in the political arena, we all are impacted by taxes, and we all must understand what exactly a tax is. Now, calculating a tax is actually the easiest part about taxes, and if all we had to do was just calculate the amount of the tax, then we would need a semester-long course for this. But instead, what is taxable is the actual hard part about individual income tax, determining all of the different rules and regulations related to what is taxable. And so we're going to start this short video. Video number 1 is going to discuss how to calculate a tax. And then there'll be 2 more videos for Chapter 1, and video 2 will cover tax rate structures, and video number 3 will cover the types of taxes and also how we evaluate tax systems. So let's get started by understanding how to calculate a tax. The first thing we need to make sure we understand is that a tax system is simply a payment that is required by a governmental agency and not directly a benefit to the taxpayer. It does not provide a direct benefit to the taxpayer. And so taxes are important to understand essentially what is a tax, because we will have some areas later on this semester where we talk about the fact that this is a fee, like a fishing license. I get the benefit of being able to fish, whereas a tax, I don't get a direct benefit as a taxpayer. So it's a payment that's required by a government agency. Now, when we calculate a tax, initially the calculation for a tax is very simplistic, it seems. We're going to take the tax is calculated as the tax base and multiplying it by the tax rate. So the calculation of taxes is quite easy. The complicated part, as I said, is when we talk about what is the tax base. And the tax base is what is actually taxed. And that's where we get into a lot of difficulties in this course, is understanding what is actually taxed. And then, of course, the tax rate is always defined as a percentage of the amount of the tax that's leveled on the tax base. Now, there are essentially 2 different types of ways that we can calculate a tax. We can do what you've probably heard of and do a flat tax. And a flat tax is essentially a single tax that applies to all income. And then we also have the situation that we have when we talk about individual income taxes, and that is a graduated tax. And in a graduated tax, The tax base, is broken into brackets. And we can see that that's the system that we use here in the United States when we're talking about the individual income tax. When we look at the tax rate schedules, we can see that it is broken into different brackets and that there's a different tax rate assessed with each of the different brackets. That's called a graduated tax. Whereas if we were talking about a flat tax is similar to our sales tax. We pay no matter whether you buy a flat screen TV or a piece of gum at the grocery store, you pay 8.25%, a flat tax. So now when we talk about taxes, there's different ways that we can talk about taxes. And we should be familiar with these terms because it will help us in doing tax planning with our clients. The first way we can talk about a tax is a marginal tax rate. The first way we can measure a tax is by discussing it as a marginal tax rate. And a marginal tax rate is the tax rate that applies to the next increment of a taxpayer's income. So essentially, the marginal tax rate is important to understand because this is the tax rate that's going to help us in our planning purposes. This is the tax rate that we look at that says, okay, if you earn $10,000 more, what is that additional $10,000 going to be taxed at? Is it going to be taxed at a higher rate than the tax that we're going to be taxing it at now? And the formula for marginal tax rate is essentially the change in tax divided by the change in taxable income, or the new tax minus the old tax liability amount compared to the new taxable income minus the old taxable income. And that'll get me to my marginal tax rate. And again, it's really useful in our tax planning. Now let's look at the average tax rate. The average tax rate is just exactly like what it says. It's the average level of tax that the taxpayer pays on each dollar of income. And so the average tax is calculated by taking the total tax that the taxpayer pays divided by taxable income. And this is really great. This is a great tool for understanding, for helping with budgeting and comparing burdens, tax burdens from one taxpayer to the other taxpayer. Oh, your average tax rate is 15%. And his average tax rate is 30%. So on average, he pays more than he or she does. So it helps with budgeting and comparison purposes. And then you'll hear tax practitioners talk about the effective tax rate. And the effective tax rate is similar to the average tax rate. It's the average level of tax, except instead of it being just on taxable income, the effective rate is the average level of tax on all income, total income. So this would be taxable and non-taxable income. And so the way I calculate it is similar. Total tax divided by total income gets us to our effective tax rate. And this one provides the best depiction of a taxpayer's tax burden. It's the one that really helps us understand exactly what a taxpayer is paying in taxes for all the income that they're getting. Okay, we're going to work two examples similar to homework problems that you have. And this is going to be our first example. And in this example, we have Campbell. A single taxpayer earns $400,000 in taxable income and has $2,000 in interest from an investment in a state of New York bond. And it says, using the U.S. tax rate schedule, how much federal tax will she owe? What is her average tax rate? What's her effective tax rate? And what is her current marginal tax rate? Okay, so the first thing that we have to understand in this example is that this right here, State of New York bond, is a municipal bond or a muni bond. And muni bonds are tax-free. When we get into Chapter 4, we'll learn some more items that are tax-free. But for this chapter, we just need to understand that municipal bonds, state and local government bonds are always tax-free, so we don't pay tax on it. So the $400,000 is going to be taxable, and the interest from the municipal bond is going to be tax-free. Now the other thing I need to know is I need to know that Campbell is single before we can go about and calculating out the amount of federal tax that Campbell owes. So she's going to owe tax on $400,000 of taxable income. And to figure out the calculation for that, I'm going to go over to my tax rate schedule. These are included in the textbook, and they're also included in the Blackboard website. So you're going to need to print a copy of this, and you'll always want to have this with you as we go through our calculations. Now notice that in this video I'm using the 2016 federal tax rate schedules. If your book has a different year, such as the 2017 or the 2018, use the year that's provided. The formulas will be exactly the same. We just don't have those years yet when I created this video. So when you're doing your homework, just make sure you use the right numbers. Okay, so here's how this works. She's got $400,000 of taxable income. And she's single. So I'm going to be in the single bracket. And I am going to come down here and I'm going to see that she's in this level because she has between $190,000 and $413,000. And then this is going to be my formula that I'm going to use. So the way I calculate it is this, and I'll just do the calculation right up here. I'm going to do $46,278.75, and then I'm going to add to that 33% of my taxable income, $400,000, that's over $190,150. Okay, so I'll do that calculation, 46,278 plus 33% of 400,000, that's over 190,150, and her federal tax liability is $115,529.25. Okay, so now that we know that, let's take that back over to our sheet and we'll put that on our sheet so we can do the rest of the examples. So she owes $115,529.25. Okay, so now the next thing it wants to do is it wants to know her average tax rate. So to calculate her average tax rate, we're going to take her total tax and we're going to divide it by taxable income. So 115,000, did I write this wrong? 529. 529.25 divided by taxable, just taxable, 400,000 gets me to 28.88%. So she has an average tax rate of 28%. So notice her tax bracket that she was in, if we come back over here, her tax bracket was 33% tax bracket. But her average tax that she pays is only 28%. And that's because not everything is taxed at the highest tax bracket. Okay, so then the next thing that they want us to calculate is the effective tax. Now remember, effective tax is the tax on all income, taxable and non-taxable income. So we'll take total tax and then we'll take total income. So total tax is 115. Gosh, I'm having a hard time writing, aren't I? 529. 529.25, and then I'm going to do 400,000 plus 2,000 here, the tax-free income, and I'm going to get an effective tax rate of 28.74%. Notice that it's lower than the average rate, and it should be because she has some tax-free income. So all of her income is going to be more than just her taxable income. Okay, so now we need to do that marginal rate. And so the marginal rate is a little confusing in this example, but we're going to think through this. So the way for the marginal rate, remember, marginal is if the tax increases, if her income increases, what is she taxed at? So we know that she's currently at a 33% rate, and that she will be taxed at 33% up to $413,350. So when we think about this, her marginal rate is 33%. And that will be up to an additional $13,350. And I got $13,350 because $413,350 is the maximum maximum taxable income for that bracket. And then if she earns more than $13,350, then she'll be taxed at the next bracket. So her marginal tax rate would then go up to 35%. So if she owns more, then she's going to be taxed at the 35% bracket. So do you see how the marginal tax rate is calculated? We look at the brackets and we figure out, okay, she can get $13,350 and be a marginal rate of 33. But if she gets more than $13,350, her marginal tax rate goes now up to 35%, and more than that, it would go up to the highest bracket, which is 39.6%. Okay, so let's look at a little different way that we can look at the marginal tax bracket and look at this calculation here. So it says, if Campbell earns an additional $15,000 of taxable income, what is her marginal tax rate on this income? And what is her marginal rate if instead she had $15,000 of additional deductions instead of taxable amount? Okay, so we'll take each scenario first. So let's do if she increases by $15,000. So what I have to do is I have to go back and recalculate out the amount of federal tax that's owed under the new scenario of $15,000. So she had $400,000. I'm going to add $15,000 to it, and so I'm going to have $415,000. And so that's going to put her into that higher tax bracket. So now she's going to be in the 35% tax bracket. And so we'll calculate her tax. I'll just do it right here. $119,934.75 plus now 35% of $415,000 minus $413,350. Okay, and I'm going to run the calculations for that, and so I come up with a new tax liability of $120,512.95. Okay, so now to get to the marginal rate, what I'm going to do is I'm going to look at the difference between those two. So the new tax with the increase is $120,512.95. The old tax liability was $115,529.25. And I'm going to divide that by new and old taxable income. So $415,000 is my new taxable income. $400,000 is my old taxable income, and that gets me to a marginal rate of 33.22%. So that additional $15,000 of taxable income is going to be taxed at 33.22%. It's more than 33 because it bumps her into that next tax bracket, but not all of it, just a little bit into the next tax bracket, right? Okay, now let's do the opposite. It says, what if it would have been $15,000 of deductions? So under the deduction scenario, it would be $400,000 minus $15,000, and her tax liability, or her taxable income, would be $385,000. So I will come over to my tax rate schedules. Whoops, that's not where I wanted to go. I'll come over to my tax rate schedules, and now she's at 318, puts her back in this 33% bracket. And so I'll do that calculation here. 46,278.75 plus 33% of 385 minus 191.50 equals 110,579.25. Okay, so that's the number that I'm now going to compare to the original answer. So I'll come back over here. Okay, so marginal tax. My new tax under this new scenario, 110,579.25 minus my original tax, 115,529.25, divided by my new taxable income, 385, minus my old taxable income, 400,000. And I get a tax rate of 33%. So notice, this marginal rate stayed the same. And the reason why is because the deduction of $15,000 wasn't enough to put us into a lower tax bracket. The only time the marginal rate changes is when we go into a higher tax bracket or a lower tax bracket. Otherwise, every dollar you earn will be taxed at the same bracket as what you're in. So when taxpayers think about getting more or less money, then they think about whether it's going to impact them, moving them into a higher bracket or moving them out of that high bracket. Okay, that's it for this short video, video number 1. When you come back and video number 2, we'll cover tax rate structures, and then we'll have one more video, video number 3, that covers implicit tax. Thanks a lot.